Hey, good morning, everybody, and welcome to this Thursday, May 30th, 2024 edition of Trading Places. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for another trading day. We just got the GDP out, second estimate for Q1, and it did come in a little bit less than expected. I believe 1.3% versus 1.5% expected. So the economy's slowing down a little bit more than what was expected. Also, the PCE came in better than expected, the annual rate, which I'm sure is going to help in terms of maybe some of the things the Fed's thinking about in terms of inflation and what they need to do with rates, when they can start decreasing and cutting those rates. The 10-year Treasury yield down this morning as a result. And on a relative basis in futures, of course, let's see what happens when we open and what happens during the trading day. But at least in pre-market action, the money is rotating back into those small caps with the IWM up a little bit this morning. In fact, let me go ahead and give you those numbers before we get started. Right now, we've got the diamonds, which tracks the Dow Jones Industrial Average, down about 0.8%. We've got the spider tracking the S&P 500, down about 1/3%. The QQQ tracking the Nasdaq 100. Of course, NVIDIA and all those semiconductors and many other high growth technology names. That index down 0.2%. But then we've got the IWM, which is up $1.32 to 203.51. That's a rise of almost 2/3%. So some of that bifurcation that we've seen and the underperformance by the IWM as a result of rising interest rates, we're seeing that flip this morning as those yields come back down. The last look I saw, and we'll look at it in just a minute. Yeah, 10-year Treasury yield right now down 6 basis points. So we've seen a big climb the last couple of days. We got up to about 4.62, 4.63 yesterday, back down to 4.57 this morning, a little bit less than 4.57. So we'll see if this is a top or if this is just a temporary pullback in the yield. Seems like it wants to head back up toward that 4.70 level. And if it does, I think it will continue to pressure equities, especially small caps. But at least we're getting a little reprieve this morning in pre-market action. So maybe we'll get a little bit of a move back there in the other direction. Let's go ahead and take a look at the action from Wednesday. Once again, the Dow Jones Industrial Average taking it on the chin, down more than 1%. It lost 411 points yesterday. So another big drop. We've seen day after day now. There for a while, we kept seeing the Dow moving up. Now we're seeing it move in the other direction. Seems like it's probably going to head back to test this area around the 37.6 area, maybe up to 38,000. Down 411 points yesterday, though, the 38,441. So another day or two of that, and we'll be there. S&P 500 dropped 39 points. That was down about 0.75%. Still above the 20-day, so you can certainly see the difference between the Dow and the S&P 500. The Dow losing both moving averages, now heading back toward those April lows. S&P 500, however, much more, just sideways action. Really haven't lost the lows from that bearish golfing and candle about a week ago, or a little less than a week ago. Still above the 20-day moving average, which is above the 50-day moving average. So this is still a bullish configuration on the S&P, even though it has been, seems like the market's been going down. Really hasn't gone down as much on the S&P 500. And then if we look at the Nasdaq, even less. I mean, it looks like we're still in a pretty healthy uptrend in the Nasdaq 100, even though we did drop 132 points yesterday, which was about 0.7%. Mid-caps falling precipitously, much like the Dow, back below its moving averages, losing 1.28% yesterday. That was 38 points. We've got that double top in somewhere around the 3,050 area. But now we've got that support from the April low down at about 28.20. Got another 100 points or so to go to get there, but it seems like maybe that would be a key level to watch after an uptrend. You've got equal highs. It's not unusual to have equal lows. One other possibility to watch for, a lot of times what I look for is a cup and handle. That doesn't work. Then I think, okay, maybe it's going to be sideways consolidation. But if it doesn't get all the way back down to that low, what we could have is equal highs, rising lows, which would be an ascending triangle. Those are the three bullish continuation patterns that I typically look for. Many stocks, many indices, many sectors that had that cup showing, the handle's fallen too deep. Normally, you don't want to see a handle fall more than a half of the cup itself. And you can already see this is probably down about 55, 60% of that, the depth of the cup, which starts to negate that pattern. Still, we could have an ascending triangle. This could turn at any point. We'd have equal highs. We'd have rising lows. The way an ascending triangle forms is you have an A, B, C, D, E pattern. A is the high. You come back down. Your initial low is the lowest it goes. That's the B. C is when you come back up, have equal high. D puts in a a higher low. So it could happen anywhere. It could happen where we closed yesterday. It could happen down 2,900. It could happen at this low coming across, or it could go all the way back down. But then again, at that point, we'd be looking at sideways consolidation. But the D would be the actual low in this ascending triangle pattern. And then E would be rising back up and breaking out. So in the short term, yes, we have some bearishness. We've seen some of our major indices roll over, particularly the Dow, mid caps, small caps, S&P and the Nasdaq, not so much. But we could, again, these continuation patterns, they're bullish, and they could form in any of the three ways I mentioned, with the handle, with the rising ascending triangle, or with sideways consolidation, where we actually go down and put in a double bottom. So until those three patterns are all negated and we break below the April low, I'm going to certainly have my short-term bullish hat on. IWM down 1.46%. That was down $3 yesterday. Pretty rough day. We're down into this gap support zone, just below 200 up to about the 202 level, closing at 202.19. So we're at the upper end of that. We do, like I said, have futures that are showing higher prices for the IWM this morning. We'll see if it lasts. Transports, I don't know what else to say. I just throw my hands up with this group. You stay away. That's all I can say until we see a more definitive uptrend begin and then actually confirm some breakouts. I think you've got to be skeptical of the transports right now. And one thing that the transports tell me, I mean, they only move up if they're expected to, or if they are delivering more goods. So when you see transports going down, it's a little nerve-wracking because it tells you the economy is not what we want to see. We had the GDP report out this morning, lower than expected. We've had, the jobs report last month came in lower than expected. So while the economy may not be horrible, it's definitely slowing, which I think takes some of the pressure off of the Fed to even think about raising rates. A slowing economy certainly will help with inflation. So, on the one hand, it depends on how you look at this. Everybody looks at it differently. You might think, oh, well, if it's bad, if the economy is weakening or maybe is expected to weaken, that's going to be horrible for the market and it's going to come back down. But if it helps us to end the inflation threat and it gives the Fed license to lower rates, the stock market's going to love that. So, you can, like I said, it's a double-edged sword. You can kind of look at it either way. I view it in context with the big picture. And my big picture tells me we're going to have rate cuts down the road. And when you got rate cuts, and I don't know if you saw, but the earnings growth in this last quarter, with almost 100% of the companies reporting, the sales growth was the strongest it's been in about 10 quarters, 9 quarters, something like that. So we're getting really strong earnings growth at the same time where we're still thinking maybe we're going to get lower interest rates. That's bullish for stocks. So it's really hard for me to look at the transports breaking down or a couple of economic reports that are lower than expected and think bearish thoughts. I've got to see much more in terms of breakdowns in our major indices. I need to see more warning signs in terms of sustainability ratios. There's a lot going on here that still, to me, looks bullish. So, you keep a ledger. Some things are bullish, some things are bearish. If you're a perma bear, all you do is you look at the bearish stuff and focus on that. Oh, transports are bad, means bad economy ahead. We got inflation out of control. Can't get it in control. I mean, that's the way you look at it from a bearish perspective. From a bullish perspective, I look at it, I'm seeing lower interest rates down the road. I don't believe that. I know the Fed is talking tough, but that's what they do with inflation. They want to talk it down. I don't see a rate increase coming. I think the next move, in my opinion, is pretty darn close to 100% to the downside. I don't guarantee anything, but if I had to put odds on it, I'd say it's above 95% that the next move by the Fed is going to be to cut rates, not raise them. But I could be wrong. I could be wrong. And if you're in that camp, you believe rates are going up, then certainly you would be more bearish what's going on in the market right now. Anyhow, let's keep moving on. Taking a look at the sectors. First of all 11 sectors were down yesterday, but I found one thing really interesting. Look at the three best performing groups with the market being down yesterday. We had communication services down 0.54%, technology down 0.64%, and discretionary down 0.65%. They were all down, but they were the three best performing groups. So now we're seeing the market rolling over, at least some of the indices, not so much the Nasdaq, but the other indices are rolling over, and yet money is rotating more out of materials, energy, and the defensive groups here on this move back down to the downside rather than the three aggressive groups. I mean, if you're really forecasting some bad stuff down the road, wouldn't you want to be out of technology and communication services? I mean, again, it just makes no sense to me. And I try to find common sense in the market. And so when I see these three groups, the top three groups on a day when all 11 sectors are down, it doesn't exactly tell me that folks are pouring out of aggressive areas of the market. And that's what you would expect if you were thinking down the road that we're going to go lower and lower. Wall Street would be rotating out of these aggressive groups. So I'm still seeing enough strength in the aggressive groups that I just can't join in on the folks that think we're going lower. Looking at the industry groups, we've got personal products losing over 3% yesterday. Clearly a breakdown below that early May low. On a closing basis, that is a new low. So that group not looking great. We've got hotels, even though discretionary held up pretty well relative to other sectors. One of its component industry groups, hotels, you can see that looks to me like about a quad bottom right there. We broke below it. We do still have the low from back in mid-February, right here at about 3,400. But still, that's not a good look, breaking below, staying below the moving averages, rolling over, and then breaking below the recent price support. Also looking at that PPO, notice when we went back up to the 50, we got it pretty close to a zero test, a centerline test. And now look what's going on with the PPO, moving back down. Now, some of you astute technicians would probably say, yeah, but look at this, lower price, higher PPO. That is a positive divergence. And I cannot disagree with you by definition. But when I see 50-day tests and I see near centerline tests, I consider it, I think the ball game is 0-0. I always liken it to like a baseball series. You know, when you go down the first game of a 3-game series and you lose that game 10-2, the second game doesn't start at 10-2. Second game goes back to 0-0. You have a whole new ball game. When we hit the center line and when we get close to the center line, hit that 50-day moving average, to me, the PPO resets and we got a whole new ball game. So what I'm seeing now is I'm looking at this, seeing the PPO is falling, which tells me bearish momentum. I don't look back at prior PPOs if we've had these tests, because at that point we've gotten rid of all that prior bearish momentum. Where I find these positive divergences very useful is when you keep trending below the 20-day and the PPO continues to go down, then all of a sudden you get to a point where you go down and the PPO starts to turn back to the upside. That to me is a much more significant positive divergence. So I'm not seeing that here. Looks to me like the hotels potentially have more room to the downside. Now, is the reading on the PPO, is that 100% accurate? Does that tell us everything that we need to know about the stock market or about this industry group? Of course not. There's a lot going on in the market. Sometimes the PPOs help us by giving us good indications. Other times they're just flat out wrong. And some non-technicians will look at that and say, see, technical analysis doesn't work. Whereas those of us that actually use technical analysis properly use it to manage risk, not provide guarantees. So if I'm managing my risk and I'm seeing hotels breaking down like this, probably not really interested in hotels right now. It's just that to me, the risk is too great. Doesn't mean they're going to keep going lower. Anyway, airlines, the last group I wanted to point out, also a rough day yesterday. They did come up way off the lows from earlier in the day, though, printing kind of like a hammer in this area of support, not quite getting down to the price support levels that we had seen back in both March and April, but still nice reversal. Maybe we get something going from here. Take a look at the airlines today. We'll see. But that is basically what I had on a recap here for yesterday. Let's look at the 10-year Treasury yield, get a quick update. We were at 4.568, so we are still down at the low. Let's pull up the 10-minute, 5-day, and you can see, I think if we were to go back down below this low, maybe that would break this trend that we have right now, but clearly we've been moving up. That low is right at about 4.56%. We're getting close. We got a low today earlier of 4.56, but we bounced. Looks like maybe we're starting to bounce back off of it. We'll need to watch this. It seems like it's almost 100% inverse relationship these days between the IWM and the 10-year Treasury yield. When the yield's going up, the IWM struggles. When the yield comes down, that's when we see a lift in the IWM. So it's coming down today. Early action, pre-market action, we are seeing the IWM up. There was a couple of reports. I talked about the GDP. We also had jobless claims out this morning, and they came in at 219,000. Market was expecting 217,000, so just a little bit higher than expected, and also higher than last week, which was revised higher from 215,000 to 216,000. Slight revision there. But as jobless claims start to, creep up just a little bit, again, it's just a little crack in the foundation of our economy. I don't think that this is anything to have, to be running for the hills, but it's definitely showing us that the economy, even though it's been really resilient for the last couple of years as inflation or as interest rates have gone higher to battle inflation, it's not totally immune to this continued period of rates that are much higher than what we had been experiencing prior. So I think the Fed's getting obviously a lot of mixed signals. It's got to try and get through all of this information and come up with the right policy. I think probably staying where they are right now makes sense, but I do believe that we are going to see rate cuts. I think we'll see them this year. Will we see them in June? I was thinking we might, or actually I was leaning toward a rate cut in June. I don't know. I don't know if they have enough information yet. We're going to get another report out tomorrow as part of the personal income and personal spending. We'll get the PCE portion of that and see what's going on there. If that comes in better than expected, I don't know. I don't know what the Fed will do. They're still talking tough, acting like they won't cut. So based on that, I would say they probably wait a little while to cut rates. But this Fed is not exactly transparent, at least in my view. I don't really know from meeting to meeting what they're going to do or say. All right, moving on, S&P 500. So there was your S&P 500 pulling back yesterday, still above the 20-day. This is about the level where we broke out from that double, triple top from mid-March or latter part of March into early April. We went through that, sideways consolidated. We're just kind of sitting here. My guess is we're going to bounce off of this area. But if we're looking for the Dow for some support, that's not going to be easy. That group's been beaten up. And by the way, I had a great question in our live trading room yesterday. One of our members asked, what's going on with the Dow? These are some of the biggest companies. Why are they getting torched to the downside here of late while, the other indices kind of go flat? And the key here is you have to understand the makeup. The makeup of the Dow is completely different than the makeup of the Nasdaq. I mean, the Nasdaq, you've got 50% or almost 50% of the Nasdaq 100 is technology. And if you throw consumer discretionary and communication services in there, you're up to almost 80% of the Nasdaq 100. So the fact that the Nasdaq's continuing to do well tells us that money is still hanging in with those aggressive areas. That, in my view, is a bullish signal. The Dow Jones, on the other hand, yes, it's got, it's got technology. Obviously, we got Microsoft in there. We got Apple in the Dow, but the percentage isn't 50%. It's more like and I believe it's like 17% in the Dow. I could be off just a little bit, but I believe financials, healthcare, and industrials are all in the top 5. And if you add up the percentage representation of those 3 sectors in the Dow, it's over 50%. Healthcare, financials, and industrials. So when we look at those other 3 groups, I mean, there's healthcare. See the drop? Let me get zero in here. I mean, you can see over the last week, healthcare really getting hit. We can look at industrials. And once again, let's zero in so you can see that. But again, over the last week or so, big hit. And then let's go financials. And financials, let's zero in. And look at the last week and a half, straight down. So if you want to know why the Dow's going down, it's just that some of these other groups that had been leading, that had actually been leading the Dow to the upside, are struggling. I mean, when you've got over 50% of the representation of an index doing what I just showed you on those last 3 charts, it's not too hard to understand why the Dow itself. Let's see if we can get the Dow up here. I mean, it's not too difficult to see why the Dow is doing the same thing, right? I mean, that's exactly what I just showed you with the XLV, XLF, and XLI. So they're all rolling over, they're all going lower, and as a result, they're dragging the Dow down with it. Meanwhile, we've seen technology continuing to do well, mostly because of semiconductors. But here's the XLK. Do you see any major rolling over here? No. XLC, still trying to forge a breakout. So we're not seeing any weakness there. The only one that we're seeing any weakness in is the XLY. And we've been seeing weakness in this group. But that isn't enough to bring down the Nasdaq when you've still got technology, especially semiconductors. I mean, let's take a look at the semiconductor index. That helps to explain quite a bit about the Nasdaq and why the Nasdaq is doing so well. So different indices are just made up of different stocks, different sectors. Percentages are different. So just because the Dow's going down doesn't necessarily mean that's going to continue to go down. It just means that the areas that it represents are struggling right now on a relative basis. And as a result, we're seeing the same thing in the Dow. Nasdaq 100, there it is. You can see still rising, still a lot of hollow candles. I mean, when you look over the look during the entire month of May, we're almost done with May. How many big red filled candles do you see in the entire month of May? I see one. And we haven't even followed through. Normally with a bearish engulfing candle like that, the next day you would see lower prices. We have not gone below the low of that day. The last 3 days, we're just sitting here in the middle going sideways. So I'm not really seeing anything. I'm not seeing any kind of major distribution in what I think is the most important index of them all in terms of growth. This is your high growth, large cap index. And that's the index that, if it does well, is going to hold most of the major indices up because of stocks like Apple, Microsoft, Nvidia, Google, Amazon, Tesla. Maybe not Tesla's not holding up a whole lot of anything. But most of those stocks have done well. Netflix yesterday made a new high. Pulling up Netflix, you can see it broke out yesterday. It pulled back late in the day, but it set a new closing high. Volume started to pick up. So it's just those high octane stocks, the high market cap stocks that continue to perform well, that are keeping the major indices afloat, especially the Nasdaq 100. IWM is struggling because we have a lot more representation of healthcare and financials. Those are the 2 biggest areas. Oh, and industrials. Those 3 areas are the top 3 industry groups in the IWM. I just pointed all 3 of them not doing well. And as a result, you can see small caps not exactly doing well here over the last week to 2 weeks. So I'm still seeing maybe equal highs. I'm seeing maybe off of an uptrend, this pullback. Maybe it's going to be an ascending triangle. We could maybe call it a lot of different things. Bottom line is, at least since last October, we are trending higher. What would change that? Well, first, probably we'd have to move back below that April low, 191 or so, 191 and a half. We've had these other two lows, which are a little bit lower, back down at 187.5, and then this one closer to 190. But I would say if you take those three lows out, then you've got an IWM small cap market that has rolled over. I'd like to see it continue to remain in an uptrend personally, just because I'm a fan of the IWM and I'm a fan of small caps this year. And the reasoning was lower interest rates ahead. So far through the first 5 months, that really hasn't been the case. We continue with a 10-year Treasury yield much closer to the highs than the lows of the last year. So still got some work to do, but I think it's going to come down to interest rates. If you wanted me to, if you wanted to pinpoint me as to which way I see the market going, tell me which way rates are going to go, because right now they're not exactly going the way I thought. But if they do roll over and they get back close to the 4% level, that's when I think you're going to see this small cap group really start to take off. Transports, again, don't have a whole lot to say. Another breakdown yesterday, breaking below the low at the beginning of May. Also, right about the low at the end of November of last year. So, I mean, think about that for a second. That huge run up that we had off of the October lows, we first kind of paused at the end of November here. We're all the way back down to that level, with the Nasdaq 100 still setting all-time highs. So transports, there's definitely a lot of money rotating out of the group. And like I said earlier, I think you have to be very careful with this group because of that. I pulled up a 60-minute chart. This is an hourly chart of the S&P 500 for the last 3 months. And on here, you can kind of see that price support was price resistance back in here. You could see we struggled to get through. Then once we did, now where are we? We're back here really just kind of testing this breakout level. That's why I still have maybe some hopes that we go up. Or, I mean, maybe this morphs into more consolidation and possibly some more selling ahead in the near term. Maybe if we stay bifurcated, where the Dow is weak, S&P 500 is maybe less weak, but still rolling over, and the Nasdaq continues to threaten all-time highs. Right now, that's how the money's been rotating. Maybe that continues. Let's see. Chart of the day. If you're new, welcome. We're always glad to have new folks join our community here at Earnings Beats. If you do like the show, please make sure you like the video and also subscribe to our channel. But scrolling down here, first you can start a free 30-day trial to our paid service by clicking on that button there. We do still have our live spring special going. It goes until this Sunday at midnight. So you can click on that link to learn more about that. But at a minimum, make sure you sign up for our free Earnings Beats Digest newsletter. Absolutely free, no credit card. Name and email address is all it takes. I think you'll get a lot out of it. Make sure you sign up there if you're not already signed. All right, last thing, I want to give you a chart of the day. Maybe I'll give you a couple of these because there were some earnings that came out last night. But the first one is CRM. I'll give you where it is this morning, which is down a lot, down almost 18%, $48 from 270, 210, down to 224 as we get ready to open. And the CRM Salesforce, there's the open. So we did just get the opening bell, just opened down at 223.40. They actually beat on earnings. The big disappointment was their revenues. Their revenues missed. And I find this hard to believe, but the headline news I saw said that they hadn't missed revenue forecast since 2006. That's 18 years. Most companies will miss on revenues. A lot of times companies always beat on the bottom line. Top line, that's kind of impressive if that's true. I didn't look through anymore, so maybe I read it wrong. But that was, if they had gone 18 years, 72 straight quarters, beating their revenues every quarter, I don't know if I realized any company had a streak that long. But anyway, maybe that's why it's such a big deal. They did miss. They said that I think their future guidance was up for earnings, but just in the same range for revenues. It seems like it's an awful big drop to me for the report that came out. We'll see whether or not we get a rebound. A lot of times when you get these sell-offs like this and companies and the news wasn't really as bad as it might seem, you got a lot of folks selling at the open, panicking. Market makers are on the other side buying. So sometimes we get that move back to the upside toward a filling of the gap. Now, I don't know if we're going to go up 48 points, but moving back up in that direction could be a possible short-term trade this morning. Other stocks that had reported, and by the way, later today, we're going to get Costco and Network Appliance. But those are two to watch later today. Last night, we also had Agilent, which had a rough reaction. Look at this gap down. Look at the already up $5, $6 from that gap down. Let's see what CRM is doing. Actually, that one's still, it's going down maybe $2 from the open. But watch if we get a reversal. If it goes back through the high of the day, so right now that's 225.09. If we were to get back through 225.09, you might see a run, at least short term, back to the upside in CRM. HPQ reported, that one gapping up, taking off, looking pretty good. Pure Storage, PSTG, also gapping up, looking strong. NTNX, they beat on earnings, but they were down last night, and they are down. They gapping lower there. Okta, software company, kind of a second-tier software company, gapped up, and look at it, already filled its gap back to the downside. Path, see big move down. I want to show you something on Path, though, because I was looking at this yesterday before the bell or after the bell. And Path, relative to its software index, before the earnings came out, was at a 52-week low relative to software. So Wall Street's already telling us, hey, we don't like this company. There's got to be something going on. Well, we found out today. Stock's down, what, 30%, 33%? Same thing, by the way, with CRM. I had already questioned CRM yesterday because not only have been pulling back on an absolute basis, but look at its relative strength. It was at a high going into March. And then suddenly, over the last 3 months, we've been losing a lot of relative strength in CRM heading into its earnings report. And then today, with this big gap down, now we're all the way back down to a 52-week low. By the way, we're back up to 223.62 on CRM. I wouldn't be surprised to see it move back up. Let's get a quick look at the market, and we'll wrap this up. Dow down 282, S&P down 9, Nasdaq down 31. S&P and the Nasdaq both down just under 0.2%. Small caps up about 2/3, 1%, about where we talked about in pre-market. So that's looking about the same. VIX is actually down today, even though the S&P is down. As I've told members, anytime you get that VIX that's below 17, I wouldn't give up on the bull market. Just saying it. Anyhow, that's it for me. Listen, everybody have a great day. Enjoy the rest of your weekend. Happy trading.